In this week's video, we will cover the most important factor in terms of catching the next big move in the markets. We'll kick off the video with some analysis of the present day market and then shift gears to lessons from history. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. It's a daily chart of the S&P 500. We still have the possibility of an inverse head and shoulders pattern forming. That would be a bullish pattern if we can break the neckline. Regardless of whether or not the pattern is in place, this is definitely resistance here. And a break above this line here is what the bulls want to somewhat negate the pattern. If we break below this blue line here, it doesn't necessarily negate it, but moving into this area here, for the most part, would take it off the table. In terms of this messy look here, markets tend to like symmetry. It took 78 calendar days to form what could be the left shoulder. If it takes 78 calendar days to form the right shoulder would complete sometime around February 7th of this year. So from a timing perspective, this isn't dead yet, but it's the support and the resistance that's probably the most important right now. We've got the same situation on the NYSE Composite, a mess of consolidation here for several months. There are a couple of differences. The neckline for the S&P 500 or resistance is sloping upward, which has a bullish bias, and the right shoulder formation was higher than the left. On the broader NYSE Composite, we have just the opposite. We have a downward sloping potential neckline here, and the right shoulder has come down below the left shoulder. All of this speaks to hesitation and gives us a lower probability of actually breaking out of the pattern and moving to the upside. We'll keep an open mind about what happens. Resistance, potential support down here, price will guide us. Taking a step back and looking at a monthly chart, you can see we have several months of consolidation and frustration here. The market's gone up and down, and really has made no progress. The key, as history will show us in the charts that follow later in the video, is to stick with our discipline here. We're still above this breakout level from 2007. If we stick with our discipline, price and the market and the observable evidence and the hard data will eventually get us in the right place. These are the Fibonacci retracement levels when we look at the move from the October low up to the December high. You can see the market bounced right at the 38.2% retracement, telling us that the probability of this being the low is improved with this being here. It doesn't mean we can't come back down. If we do, all three of these areas on the S&P 500 represent areas where buyers may step in, and that speaks to probabilities. In last week's video, we discussed the use of longer-term moving averages to help deal with the whipsaw patterns that we've had on many charts recently. These are moving averages, weekly moving averages. On the weekly chart of the S&P 500, you can see the slopes of most of them, if not all of them here, are up, which leans bullish. However, notice the slope here relative to the slope here. This is a much more confident trend and lower risk situation than what we have now as of the close on Friday, January 9th. These flattish slopes here are telling us that we've got an indecisive market and we need to pay close attention next week. The way we use these moving averages here conceptually is the same as the way that we use all moving averages. This is 2014 here. You can see again the slopes, for the most part, the bias is up. This is what risk off looks like here, where we have just the opposite, where the bias is clearly down. This is a bullish period in 2013. So by monitoring the observable evidence, we can understand the market's risk-reward profile in a little bit more detail. We're using the same moving average concepts here. These moving averages are just a little bit faster. This is our consolidation here. We'll try to be as patient as possible within the context of the rules as long as we're moving sideways here. This would obviously be a bullish resolution. This would be a bearish resolution from a probabilistic perspective. Sideways and flat tells us that risks are higher now than they were here. So we have to be ready for bullish and bearish outcomes when we have a look like this. We still don't have a clear resolution on this long-term consolidation between TLT and SPY, or bonds versus stocks. You can see when the ratio was rejected at the top of the box, stocks rallied, rejected at the top of the box, stocks rallied. We don't really have a decisive move either above the green line or below it, which tells us to remain disciplined and open-minded. This chart here dovetails nicely with the historical analysis that's coming soon. As we discussed using this graphic last week, it's important that we remain disciplined because we could be getting a big move in stocks or bonds. If the market decides to go in this direction, it'll favor stocks in the short run, and bonds could get hit hard. If we move in this direction here, stocks could get hit hard, and bonds would be the place to be. The lesson from history in terms of how to handle an indecisive market is illustrated nicely with this chart of the NYSE Composite from 1981. The longer we consolidate and are frustrated and have an indecisive market, typically the bigger the move that you get after the breakout, either down or up. So the moral of the story in the present day is we have to stick with our discipline, because if we do, then we can catch potentially a big move that's coming. If we break our discipline in here, invariably, after suffering through the frustrating period, if we break our discipline, we'll miss this move. Similar situation from 1982 and 1981 here. We consolidate, break out of the box, and see a big drop. A twin bill from 1983, consolidation, big move, consolidation, big move. 1984, if we became frustrated, lost our discipline, started breaking rules, we would have missed this big move in the stock market. 1985, a 1, 2, 3 month consolidation, a breakout, and a nice move. Multiple week consolidation from 1986. Another frustrating period that occurred later that year, followed by a big breakout. This chart from 1987 reminds us that we can't assume that the breakout in the present day will favor the bulls. We have to respect the possible need for risk management if we get a bearish breakout. Running a system similar to the market model in 1994 would have been very frustrating in here. However, if you stuck with your discipline, there were big rewards on the other side. Dot-com bust consolidation and a dot-com plunge. Difficult markets are often followed by easier markets. Typically, the longer the consolidation, the bigger the move. It would have been very frustrating if you broke your discipline inside this box. When the Fed starts raising interest rates, sometimes confusion reigns. You could have doubled your pleasure in 2005 if you stayed with your discipline. Is it possible that we're seeing a long-term topping pattern in the markets in 2015? Sure, anything's possible, and that's why we have to keep an open mind about we can get bullish or bearish breakouts from these boxes. We'll close with a quick update on the low conviction market model. These are the results that we talked about last week. We've been refining the model and diversifying it. Similar results here. We mentioned last week that we've been working diligently behind the scenes for several weeks. We have answered over 69,000 binary questions during this research project. We did it manually. The reason why we do it manually is you learn a lot by stepping through the charts on a week-by-week basis. This will give clients a little bit better feel as to what we looked at. We looked at over 130 different inputs in terms of dealing with the recent whipsaw environment and V-bottom environment that we experienced in 2014. Out of the 130 plus, we kept roughly 36 throughout the rest. We weighted them relative to their usefulness. You can see these are the 69,000 plus answers to questions when we reviewed charts over the past several weeks. The research has enabled us to head into 2015 with an even stronger market model and toolkit. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.